Index funds versus individual stocks. What beginners should actually do. Every new investor eventually faces the same fork in the road. Chase the exciting stock everyone's talking about, or go with something quieter and more boring. Today we're settling that question with a clear-eyed look at what actually works for most people, most of the time, and why the boring choice usually wins. A stock is a small ownership piece of one specific company. When you buy it, your outcome is tied entirely to that one company's decisions, competitors, leadership, and luck. If it does well, you do well. If it doesn't, there's nothing spreading that risk out. An index fund is a basket that holds small pieces of many companies at once, sometimes hundreds or thousands, designed to track a broad market index. Buy one share, and you effectively own a tiny slice of the entire basket in a single move. It's easy to see the appeal of individual stocks. There's a sense of control, of being clever, of finding the next big winner before everyone else does. And you've probably heard the story of someone who put money into one company early, and it changed their life. Those stories are real. They're also rare, and survivorship bias means we mostly hear about the ones that worked. Here's the risk that story leaves out. A single company can also decline sharply, or fail entirely, no matter how strong it once looked. When your money is concentrated in one place, there's no cushion. A diversified basket doesn't have that vulnerability, because no single company can sink the whole thing. Widely cited industry research has repeatedly found that most professional fund managers, people whose full-time job is picking winning stocks, fail to beat a simple broad index over long stretches of time. That's not a knock on their skill. It's a sign of how genuinely difficult consistent stock picking is, even for experts with research teams. The advantage of an index fund isn't that it magically finds the best company. It's that it owns all of them, including whichever ones turn out to be the future winners, so you never have to guess correctly in advance. You capture the market's overall growth without needing to be right about any single pick. Even setting the numbers aside, there's a behavior problem with owning individual stocks. Watching one company's price swing wildly makes it far harder to stay calm. People panic sell on bad news, or chase hype on good news, and that emotional whiplash is often worse for returns than the stock picking itself. Broad index funds tend to have very low expense ratios, sometimes a fraction of a percent. Actively trading individual stocks usually means more transaction activity and, outside tax-advantaged accounts, potentially more taxable events along the way. Those costs are small individually, but compound the same way fees always do. None of this means individual stocks are forbidden. Some people keep a small side allocation money they could genuinely afford to lose for a company they've researched and want to own directly, purely for interest. The key is keeping that separate from the core money that's actually funding your future. Index investing suits a long-term, largely hands-off approach. Set it, automate it, leave it. Successfully picking individual stocks over decades typically demands ongoing research, and monitoring. Most people don't have the time, interest, or edge to sustain consistently for that long. A common myth is that index funds are too boring to build real wealth. In reality, the unspectacular, unglamorous decade-after-decade compounding of a broad market fund is quietly how most durable wealth actually gets built, not lottery ticket-style stock picks that make for a better story than a strategy. To be fair, some people genuinely can handle the volatility of concentrated stock positions without losing sleep or making emotional decisions. Most people can't, and there's no shame in that. Knowing which one you are matters more than any specific stock pick. So here's the practical takeaway. Start with a broad, low-cost index fund as your core, automate contributions to it consistently, and let time do the work, the same foundation we laid out in our beginner investing video. If individual stocks interest you later, treat them as a small, separate hobby allocation, never your whole plan. Let's recap. A single stock ties your outcome to one company. An index fund spreads that across many, including tomorrow's winners you don't have to predict. Most professionals can't consistently beat that approach, and the behavior and cost advantages favor it too. Build your core there first. If this helped, follow Liberty Wealth Insights for more financial education, made simple, in plain English, no jargon. We'll see you in the next one.